Welcome to the daily update, where I'll go over the action in the market from Monday, August 12th. And then we'll see how things look for Tuesday, August 13th. Pretty slow day. We have PPI on Tuesday. We have CPI on Wednesday, retail sales on Thursday. It was not nearly as wild as it was a week ago, and everybody was talking about it. Well, it was a pretty calm day, and we saw below average volume ahead of these major economic reports that are coming out. Now, we're still negative in the short and intermediate term, but we are seeing a bit of an improvement, and some of our indicators are trying to turn up and turn more positive, although they haven't turned positive yet. I do have a thing called the SPXInvesting Program. It's free right now. There's a link below this video that will take you to the website, as well as to some more videos that talk about the program that I have. And here's an email address if you see a need to contact me. Also, the video that you're watching right now, the daily video, this is the real foundation of the analysis that I do. All of the other videos, like I did over the weekend, they're weekly videos, and they're meant to supplement the daily videos. All right, let's go back and talk about what happened. We had a slightly higher open. Futures were holding up fairly well before the market opened. And right after the open, though, we saw some selling coming in, and it took us down below the unchanged level and a little bit below the daily pivot at 53.35. Then we were able to rebound up to R1 at 53.68. And as we went along, prices fell back below the unchanged level and the daily pivot and just chopped. They were a little bit above, a little bit below both the daily pivot and unchanged level. And we closed pretty much unchanged on the day. So there was no change there on below average volume. We are negative in the short and intermediate term, as I said, but showing signs of improvement. And hopefully the reports that are coming out this week, especially on Wednesday with CPI, that's kind of the big one, but they're all big, will shed some light on what the market's going to do. We had been going from this idea that the economy might be stimulated by interest rates being lowered, and the market liked that. Well, then when we had the employment situation report that was much weaker than expected, that shifted it over into a fear mode where maybe the economy is getting ready to fall off a cliff. And now bad news was becoming bad news. Well, we're kind of drifting ever so slightly back over to this idea that, okay, maybe things aren't so bad after all, especially when you saw the huge reaction a week ago Monday with everybody talking about it and people posting things that don't even know what this means. And you had all these declarations of needing an emergency rate cut and all that stuff. That pretty much means we're about at the end at that point, and it had been building up. Well, since that time, since last Monday, we've been able to at least chop our way back and turn a little bit more positive, in that we're not positive yet, but we're showing signs of improvement. And we want to keep an eye on the geopolitical concerns. For those of you that pay attention to history and so forth, as I'm recording this, this is known as the 9th of Av. It's AV. It's a Jewish month. And if you look back through history, and a lot of bad things happened to the Israelites during that time, both in ancient times and in modern times, well, that's today. And so there's this threat of Iran attacking Israel. Don't know if it's going to happen, but other bad things have happened on this day in history. It's kind of interesting when you look at it and compare it to American history, where we have December 7th, we have 9/11, we have different events that have occurred along the way. They're all on different dates. Well, throughout Jewish and Israeli history, they've all tended to fall on the same date, even though it fluctuates because their calendar is based on the lunar year, similar to what they do in China. But anyway, just be aware of these things. Hopefully it's a non-event and that somehow things can settle down, and it'll never get better because there's been strife there for so long, but at least get to a more manageable place where at least people are talking instead of trying to blow each other up. And there's still the concern about what's been going on in the UK. The Olympics are now finished, so we'll have to see, does something else replace it with what's going on in France and the rest of Europe right now? But just there's a lot going on right now, and it seems to happen very fast, and it seems to be very intense. But so far, the market is not really paying attention to it. Okay. Some comments. They were very quiet indexes on Monday ahead of PPI, CPI, and retail sales. You could also put housing starts that's going to come out on Friday because that's a leading indicator. Small caps didn't have a good day on Monday, and we're still looking extreme negative with the slope oscillator. And although it's turning up, and I'll show you that chart where it's trying to show some signs of improvement, but it hasn't crossed above its moving average at least yet. In the intermediate term, the TTM squeeze trying to show some improvement there, but still looking rather extreme. Also, with the ease of movement and the chicken money flow, these are all extreme, but they're starting to inch their way back higher. And we'll see if the scenario is able to change this week with the CPI report coming out. But the market is possibly going from this, okay, the Fed may cut rates and the market likes that to stimulate the economy. Or are they going to shift back over to, oh my God, the economy is really in trouble and now we need to fear that we're going to have a recession and the Fed will be cutting rates just to try to save the economy. We're kind of, we'd gone from one side that's more positive and then we suddenly went over to the negative side. Now we're kind of drifting back a little bit over to the positive side again. We'll see if it can stay that way. The dollar was unchanged as well. Interest rates were down. We're at 3.91% with a 10-year yield, where after Friday we were at 3.94%. We're still inverted with the yield curves. Now the 10 to the 2 is getting close. It's still inverted, but it's getting closer to going back to switching normal. We were unchanged with sentiment, where we closed at 24 after Friday. We also closed at 24 after Monday. That's extreme negative. And this is the point when we look at using this as a contrarian indicator, even though we've been camped down here for a little while now. This is a little bit different. Usually when we have a longer term uptrend and we go down, we hit support, we hit extreme sentiment, and then we bounce up out of that. Well, we are climbing up out of that, but we're not really seeing any conviction right now because there are so many variables that the market still has to deal with especially with economic reports. And we're still negative with the trend. The ADX is just barely above its moving average, but it's rolling over. We have another update that's probably going to drop below its moving average, turn to a weakening trend. But the red line's still on top. And if the green line can come back and cross above the red line, that would turn things more positive. And again, I'll show you charts of all these things here. And I'm still keeping the bias at positive because we were unchanged virtually. And I'm keeping the momentum at mixed, even though you could possibly tilt it a little bit to the positive side for right now. But there's just so much left that the market doesn't know right now. And we don't know how the market's going to react to that. Okay. We just had the Treasury budget come out, which means the government's spending more than they're bringing in right now, and it actually increased. It was down to a minus 243.7 billion. And this is not seasonally adjusted, so to get more of an apples to apples comparison, you have to go back and look at this a year ago. So they're spending more. All right, no charts to show. I don't show a chart of that particular economic report. And then looking at what do we see as far as advances and declines, putting it all in perspective. And this is what's been happening in 2024. We're still up 11.5%, but we saw the pullback down here. And yeah, I mean, it's severe and people freak out and they think, oh my gosh, everything's falling apart and the perma bears are partying. Well, when you put it in perspective, it's not all that drastic based on what we've seen, at least to this point. And then looking at equity positioning, we are seeing money actually starting to come out now. It actually dropped below the 0 point after we had become extreme positive with this. There's a lot of folks that are demonstrating a lot of fear, which could end up being positive for the market. And looking at what are people putting their money into and taking their money out of, one thing that's really interesting to me is at the bottom, they're taking it out of staples. And if you look at staples by itself, it's looking really good. I went over it in the intermarket analysis video over the weekend. It's in a solid uptrend. Now it's underperforming the S&P 500, but by itself, it's looking fairly positive. What's really been doing well now is people are chasing the utilities because this has been a stronger area. This is also potentially a defensive area. And folks have been getting into this. Well, now they're continuing to get into it because now it seems like to be the right thing to do. That's really all I wanted to point out. You might want to pause this and look at different areas that are seeing inflows versus outflows here. And then looking at cyclical stocks, these go up when the economy's doing better. They go down when the economy's not doing very well. And when we saw that big sell-off a week ago, this really was quite extreme. And this is usually an extreme negative reading. And so this could also be used as somewhat of a sentiment gauge that folks were just all freaking out for thinking that everything was the end of the world, even though they were reacting to what they're hearing instead of anticipating it by looking at the charts. Then realize that means you take inflation into account and implied, this is what the market thinks, the correlations. It spiked this week from extreme lows as of August 8th, where we had come down here. This just means that they're not anticipating a real pickup in volatility. Well, now that's starting to really change, especially when we had the real down day. You saw this really spiking up. And you'll see here the light blue line, this typically outperforms by quite a bit when we look at the realized. This is the actual volatility that happened with the VIX really going up. And we use this a bit when we're analyzing different option positions and strategies that we look at. We sometimes look at the implied volatility. That's what the market thinks. And then the blue line is the real volatility, or sometimes we might refer to this as historical volatility. And then the market implied change in the Fed funds rate. They were pretty much expecting that they were going to be lowering rates here, but then that ticked back up a little bit recently. And then I am going to spend a little bit of time here since Monday was quite a calm, quiet day. Edward Yardeni had a couple of posts that I'm going to take a little bit of time to go through what he's seeing right now. This is looking at earnings, and we want to pay attention to earnings because that's ultimately what drives stock prices. They're at a record high during the second quarter. The first point here, new high, the S&P operating earnings per share, they rose 10.9% on a year-over-year basis. And then there's a chart I'll show you here. Just before the start of the second quarter of earnings season, analyst consensus was at 9.1% increase. So they actually are looking better than what was forecast. And, that's a little bit of front running. They're trying to lowball it so it makes things look better. It's a tactic that is used. And this is what it's looking like, where we're seeing higher than ever earnings per share, operating earnings per share here. And so, again, if things were falling apart, would we continue to see this chart going up the way we are? Another point, quarterly earnings per share estimates. It says company managements gave negative guidance, again, lowballing it, looking at the third quarter by 2.7% over the same period. And this is what we were seeing here as they're bringing things down. We can compare all the quarters with each other. Of course, by the time we're beyond the quarter, that flattens out. It was actually raised up a little bit in the second quarter. Now we're starting to focus on the third quarter and then eventually the fourth quarter. And that's another tactic that is used to make things look better. It says annual earnings per share estimates. Nevertheless, 2024 consensus estimates remain flat during the latest earnings report, and as did the 2025 consensus. And so we'll look at this here, and the 2026 remains up 13%. This is just looking out. Here we have 2020. Here was 2023, which is history now. 2024, and then looking out here into 2025 and then 2026. And that's commonly what you'll see is you see more optimistic earnings going out into the future. And this is what I go over in the weekend video. The red line here, this is the forward looking. Well, I do it on a PE ratio basis, but this is also continuing to go up as well. So looking fairly healthy now. Forward earnings, as long as a recession doesn't materialize, they should continue to be bullish. And so here's another chart of that, where we're seeing both the earnings per share, that's the blue line, and then the forward earnings per share, the red line, continue to go up. And that is looking rather healthy. Economic growth, and we're going to deal with CPI this week, and we have the thing called the coincident indicators and payroll employment as well. This is the non-farm payrolls and then the earnings. Both continue to go up. So when the economy is falling apart, you don't see these charts going up. You see them going down. And profit margin, it rose 12.3% during the second quarter. So here we go, looking that augurs. Well, okay, I'm not the only one that makes typos. Interesting. Then this is quarterly against the weekly forward profit margins, and both lines are going up. So things are holding together for right now. Then the other post that he made, because of what's developing and what has been developing in the Middle East, is the oil price anticipating an imminent war between Iran and Israel? Okay, well, here's some bullet points. The Israeli intelligence community is reportedly believing that Iran has decided to directly target Israel in retaliation of an assassination that was made there, the Hamas political chief. And this was made after the Iranian Revolutionary Guards and the new Iranian president, they all talked about this and said, kill Iran or kill Israel. And then, so the IRG has been pushing for a more severe and widespread response than the April 13th attack on Israel. That's when they sent, 300 drones and missiles, and not one of them. There was like one girl, I think, that was injured in that whole thing, but nobody died and so forth. Then, in a call on Sunday night, Defense Minister Lloyd Austin said that Iran is preparing a significant attack against Israel. So what they've done is they're sending the USS Abraham, the carrier strike group, along with a bunch of F-35Cs, and just a little tiff going on here. They want them to go a little faster to get there. They're also sending the USS Theodore Roosevelt carrier strike group. I just watched the documentary on Theodore Roosevelt. What an interesting guy. I've studied him over the years. Just fascinating, the passion. He took extreme grief and turned it into an intense passion. Now, some of the things that he did, you can argue were good or bad, but what an interesting person. All right. Anyway, if the attack happens and causes significant casualties and damage, the result might be outright war between Israel and Iran, and oil could really jump up. It did go up 3%, but we're not really seeing a breakout yet. And here is oil. And I have another chart later on to show you oil as well, where we got up into the 80s here, where we're still kind of dealing with the mid to upper 70s right now. We just haven't seen a real big reaction to that. So it says our energy sector overweight hasn't played out as well as our overweights in tech and communication, industrials, and financials. Fortunately, at just 3.7% of the S&P, energy is an easy sector to overweight in a portfolio these days. Okay, that's how you justify things. So Edward Yardeni, based on what he recommends, they were overweighting in energy, but it just hasn't really gone according to plan there. But it's still, at least anyway, all right. Then we look at the S&P 500, 400, which are the mid caps, 600 small caps. The stock price indexes have rallied along with oil. And then this is just showing where the S&P has been bouncing back up after we saw that pretty severe decline on Monday. And then we've been recommending overweighting gold, and that's what happens. And we've been seeing gold. It closed at, I think, an all-time high on Monday. When there's a lot of geopolitical instability, folks tend to gravitate towards gold. It's ultimately, if you buy gold, it's a tangible physical asset that's always been worth something and always will be worth something. Where if you have a piece of paper saying that you have something that is of value, well, it's sometimes only as good as the paper that it's printed on. Just like back in Enron days, you could get more money by buying an Enron stock certificate on eBay than you could from actually selling the stock itself. So here is just a look at the spot price for gold, where it continues to go up and is possibly breaking out. And if we see more unrest, that probably could happen, which will make a lot of the real gold bugs happy and talk about what geniuses they think they are. Okay, then a couple charts that I found here. This is actually a repeat because I want to stress this idea that if the Fed is going to cut rates in September, why are they cutting them? What is the context for rates being cut? If it's because they want to stimulate the economy and we don't go into a recession, that can be really good for the S&P. If it's because the economy is really weakening and possibly going into a recession, that could be really negative for the S&P. That's why we watch this good news, bad news, back and forth scenario all the time. Because sometimes you can't just see it on a chart. In my course, I teach about, okay, there was a period of time when they were raising rates, and the market was just going up and up and up. And there's other times when they're lowering rates and the market's going down. You have to know the context of what was going on at that particular time. And this was put out by Chris Schiavocco. He showed it in his weekly video and then he posted it on Twitter. This pretty much says the same thing. When the Fed is able to ease rates slowly to try to stimulate the economy, that really helps stocks. If they have to do it in response to some kind of an economic event or the economy is really slowing down, that changes the whole scenario. And then over on the right-hand side, he actually has a whole spreadsheet of what happened. And I'm not going to go through that, but if you want to look at this or go on Twitter and find this, it pretty much backs up. The idea here, I will just kind of highlight the slow. Look at how everything's green. 1 month, 3 months, 6 months, a year, 2 years out. Everything's green there, where we start to see a mixed picture otherwise. And then looking at the slow movement here as well. Okay. And then this is put out by Bar Chart. These are commodity trading. What's that? Commodity. They trade commodities for other people. And they're projected to sell global stocks in every single scenario over the next week. Now, this is short term. Up to 64 billion if the market trades lower, warns Goldman Sachs. They track this thing. And this is kind of what I focused in on here. Over the next week, if they're flat, they're going to sell 40 billion. If we're up, they're still going to sell 20 billion. If we're down, they're going to sell 64 billion. So there's some negativity built in, at least according to these guys, whether it's going to have a real impact on the market. Now, this is not necessarily considered the smart money. Sometimes this is considered the big money, kind of like hedge funds, but I wouldn't necessarily put these folks in the smart money crowd. And then we are seeing a bit of delinquency increases here with balances over 90 days. And of course, the student loan thing, which, yeah, okay. But the thing I'm focusing on here is credit cards, that we're seeing real delinquency as folks have been having to live off of their credit card just to buy food to put on the table. This I thought was just more interesting. Stock ownership, and it's the highest that it's ever been, that most people own stocks. That's why I try, and it doesn't always work that way, but I try to make the videos, even if you don't invest in the stock market, I still hope people find value in the videos that I post, because your 401k, your Roth IRA, your retirement at work, something that you inherited. You may not be a real active participant, but the hope is that you still need to pay attention to what's going on, and you might find something useful from what I do, because we have almost half of the whole country that owns stock. And so that's why it's such a big impact on the American culture. All right, and then looking at electricity consumption, this is comparing companies or countries like Nigeria, Ireland, and Serbia, and then we have Google. I mean, a lot of companies use as much electricity as countries do. Meta down here, and Apple. I mean, they're on this list. And what's going to happen if this whole Green New Deal thing actually starts to take over, and they keep on saying the old way of making electricity that has to be done away with, and they're doing away with dams. I'm from Washington State. We have Grand Coulee Dam, a lot of big dams there. A major part of electricity is generated that way. What if they suddenly decide not to do that anymore? What's going to happen with these things here? Because electricity, of course, is very needed, and then we've got the whole EV thing that's been happening as well, as they're trying to do away with regular cars. All right. Markets are pricing more Fed cuts in the next 12 months. When this is going down, I don't know how they figure this out, but somebody sits around with a spreadsheet or something and just goes, the market's moving in this general direction. It's a 12-month forward change in the implied change in the Fed funds rate, and they think that rates are going to be going down. But again, what's the context going to be? Is it because they want to stimulate the economy and help things improve, or because the economy is really running into some difficulty? And then I think this is the last one. California accounts for half of the companies that are moving to Texas. Yeah, it's not a real business friendly environment in California. They pass so many different regulations, and that a lot of companies are just saying, we're leaving. We want to get out. Okay, here is the intraday chart. So we did have a little higher open, but immediately we came down below the daily pivot. We got back up to R1, then we came back down to the daily pivot, and then we just kind of chopped sideways going into the close, and we're unchanged on the day. We're coming up with the blue line. We're coming down a bit here with the red line, but the red line is still on top, meaning that value is outperforming growth intraday, and we're pretty much flat here. It was just a really boring day. We saw a little bit of improvement intraday here with the growth outperforming value. It was above the dashed line, which means growth was doing a little bit better. And then end of day, growth was up where value was down for the large caps. It was down a little bit more with the mid caps and down about half as much. No, not quite. 0.79%, where small cap value was down 1.44%. So we saw a little bit of a tick up here, but no real leadership, no real strength at this time with small cap growth to value. When we look at the ratio here, a little bit more of a tick up with the mid caps, but not an awful lot of strength. A little bit of an improvement, but not really breaking out with S&P growth to value. And we are seeing a little bit of an improvement here. And this could be rather encouraging. We were able to get back above the 250-day moving average, and we've been climbing, just inching our way back up into the rainbow. So this is showing some improvement. But when we look at discretionary to staples, ticking back up, but still, it's in a longer-term uptrend, but it's just not showing any real strength right now. Large cap growth was able to get back above and stay above its 100-day moving average. Now, can it get back above its 50? That would turn things even more positive. And we're seeing this ratio going back up as large caps are starting to outperform the small caps again. Condition of our trend, just about ready to roll over below the moving average with the ADX. When it does, that means it's a weakening trend, but we're still in a trending environment because we're above 20. We're still negative because the red line, even though it's going down, is still on top. In order for this to turn positive, we need the green line to come back and cross over the red line. And we're seeing a little bit more of a drop now in the short term, where this is already showing a potential weakening trend, but it's still negative even though the red line is coming down. Volume really dropped off. And this is more like what we see usually in summertime. Here is the weekly chart taking a bunch of different sentiment gauges, and we're getting more into the high end of the neutral camp right now at 58.39. Looking at the insider transactions ratio, this is actually becoming bullish as there's been a lot of insiders. Now, this is legal insider transactions where they've been doing some selling. And just like everything else, the insider buying ETF, it got hit, but it's been bouncing back up, even though it was down, was at 0.5% on Monday. And the Ulster Index is coming down, but still giving a very high reading. That just shows there's a lot of fear. Also ticking up a little bit on a closing basis with the VIX coming down, and actually, once we get down back below 20, if that ends up even happening, that's going to switch things back more positive, especially when you compare it to where we had been over the last week or so. But when you look back a couple of weeks, when we were down in the 13, 12 range or so, when there was almost no fear whatsoever, this just looks like a monumental move, which it would be under any conditions. We're also seeing the VIX of the VIX going back up just a little bit, both with the bar chart and the line chart. And because we spiked up and came back down, we're starting to see the momentum begin to roll over. It hasn't quite crossed here with the MACD, but it is starting to at least turn down a little bit. And this is the seasonality that we see, and we're so far kind of matching up with that. We went up, and this could be some hedging ahead of PPI, CPI, retail sales coming out. So we were unchanged on the day, but we did see the daily equity put call ratio go up, but we're seeing the 5-day going down, and the 10-day is now starting to go back down, and that's more positive when they're declining. And keeping an eye on this as well. This is the spread between risky and not as risky bonds. Where we get more insight is this next chart. We're watching the middle area. This is the spread, but it's inverted, where we had got to a really high reading as everything was freaking out last Monday. This has been coming down, but we're still getting a high reading overall. We want to see this continue to go up, which means fear is decreasing. And we actually were up just a little bit, just a tick when we look at this fear gauge, and we were also up a little bit here with this other fear gauge. And looking at the risk on versus risk off, we really fell off when things declined a week ago. This is showing some improvement here as folks are trying to get back more into the risk on type of camp if things remain positive. Now, if they turn negative, we're going to see this ratio continue to decline. The volatility risk premium, after being very, very high, has really dropped down, and we're actually very low right now, below the band. And we're still holding up okay. When we look internally at the S&P, we declined a little bit based on price. We were flat based on volume. The one negative divergence that we've been pointing out is that we were going down faster with volume than we were with price. That's a little bit of a concern, but the fact that we're still above the moving averages with both of these is longer term positive. And the internals, as measured by the new highs, new lows, also looking good. Saw a few new highs, a few new lows. We're still declining with the 5-day and the 10-day, but we're not really breaking out either way right now. And we're declining, but still above zero with our advanced decline ratio. That remains positive. Working off of getting far away from this moving average when we look at accumulation distribution, but we're still below the moving average. We want this to cross back above the red line for this to turn positive. And also, after getting extreme negative with the Chaikin money flow, we're starting to slowly turn back up with the red line. So even though this is negative, it's showing some improvement. And we're actually looking better here with the Chaikin oscillator. It continues to advance. Now, it's still negative because it's below zero, but it's showing some improvement there. And looking at the advanced decline line cumulative for the S&P 500 based on price, we ticked down. We just showed very little change here based on volume. And the cumulative is still showing a little bit of weakness here with the NYSE. But when we look at the regular NYSE advanced decline line, it's still holding up quite well. This other advanced decline line is also holding up. We look at the common stock, ticking down just a little bit, both based on price and volume, but holding up for the most part. And we're still seeing the red line above the bar chart here. That just, even though they're different on different scales, when the red line is above the S&P bar chart here, that just means the market is stronger on a broad market basis. And we're actually seeing a little bit of weakness. We dropped slightly below the moving average with the mid caps, where we're still holding up with the NYSE common stock, the S&P, and even the small caps. They declined, but they're still above the moving average. Here's our short-term chart. We're coming up. We could hit some resistance at this pivot point here. We want to be able to break through that possibly. And the condition of our 20-period moving average looking a little better. We're finally getting back above both of these lines here, and the lines are starting to flatten out and possibly turn back up. The 20-period moving average, though, we're still below both the simple and exponential. And we're not extreme with the Stochastic RSI, slightly positive since we're above the midpoint. We're right at the midpoint here with the Williams percent R, showing a little bit of improvement with the CCI 14 and 20, but still negative. Nothing is extreme here with the stochastics chart on any time frame, but showing some improvement nonetheless. Still negative, but improving slightly with the force index. Going down with the 20-period, 50-period, and 200-period moving average measured right on the S&P itself. Still in the -1 standard deviation here with the trend channel for this. We're below the midpoint, so that's negative, but we're not necessarily extreme any longer. Balance of power, pretty much flat, still negative. Looking at the condition of the 50-period moving average, still below both the red and blue line here, but showing some improvement there. Actually switching to more of a neutral negative with the go, no go. It's a lighter shade of purple instead of the smoke on the water, deep purple. All right, and we're bouncing up off of the lowest low value here. That's the red line. If we can get back above the midpoint, that would be more positive. And we're coming back up to this anchored moving average that's measured from the April lows that we saw here. Can we break through that? Is this providing some kind of overhead resistance? And I've been keeping an eye on this. When we were declining last Monday, from the high that was set on July 16th to the low was almost 10%. That's when we saw buying really coming in. And since that time, we've been showing some improvement along the way. Can that continue? The TTM squeeze is still extreme negative, but showing some improvement with the lighter shade of red. We're coming down a bit as we're slowing down with standard deviation. And the Erin continues to be going sideways, but is negative since it's below zero. We dropped back below zero with the S&P McClellan oscillator. So that's turning things more negative. So we're declining here based on price. We still continue to decline based on volume. And we're still below zero with the NYSE McClellan oscillator. So we're going down with the summation index based on price and volume for the NYSE. And we're seeing some improvement with the ease of movement, but still well below zero. This is encouraging. We're seeing the Swenlin trading oscillator crossing back above zero based on price and just barely above zero based on volume. But we continue to be neutral with the Elder's Impulse system for the S&P. Momentum is trying to turn back more positive, or at least shifting a little bit here with the PMO, trying to turn back up based on price and volume, but they're both still negative. We saw a little bit of a decline with the PMOs that are rising. The buy signals were a little bit of a decline. We were flat with the PMOs that are above zero, but we're still negative with the parabolic SAR. And we're also negative with the weekly chart. If you watch that video, this is potentially encouraging. The slope oscillator is still extreme negative, but turning up and starting to cross above its moving average. We're also seeing a bit of a turn up with the MACD. This is more short to intermediate term, but we're not above the moving average yet. So we're seeing some improvement in the short and intermediate term, where we're still declining in the long term with our oscillators. And we're keeping an eye on the 50-period moving averages, just in case we do continue to go up. Will one of these end up providing overhead resistance? And we're above the 100-period moving average, so will this continue to provide support? And here's our moving average tree, where we're kind of in between the 50 and 100s now. We're going back up, looking a little better with the Sean trend meter, but not extreme. And we were able to cross back above 50 with the bullish percent index for the S&P. So now this has turned back to positive. We're turning up, but still negative with the NYSE bullish percent index. Also going up, showing improvement with the NASDAQ 100 bullish percent index, but we're still below 50. And we're still below 50 here with the money flow. We're ticking up, but below 50 with the ultimate oscillator. We're flat with the vortex with the red line on top. That's still negative. We were able to cross back above the moving average with on-balance volume. That is turning things slightly more positive. When we look at those stocks above their 20-period moving averages, we're still below 50 and declining. We're still above 50 and declining with those stocks above their 50-day moving average. Declined above with those stocks above their 100-day moving average, but we're still positive here. Also a decline with those stocks above their 200-day moving average, but well above 50. The Copic curves trying to turn back up, but is still negative. Mass index, we're waiting for the third part of this signal. This just continues to go up and up and up, and until that happens, we'll see. This is trying to indicate that whenever this third part is triggered, that means there will be a reversal. We don't really know the context yet. Is that going to be to the upside or to the downside? And we're seeing some improvement, but we're still negative here with the RSI 14 and 9. Both are still below 50. And we're dropping off here with our 10-day average of the S&P 500 highs minus the lows. This continues to fall as more recent prices give more weight to this calculation. And we're coming back up, but we're still below this mini rainbow with our 20-period moving average study here. And the more we stay below these lines, the more these lines will continue to decline. We also just want to keep an eye on the fib retracement level. Going back to the all-time high, we didn't quite get down to that level last Monday, and we've been bouncing up from that. And we're still in the cloud here with the Ichimoku. We're negative because the red line is above the blue line, but we were seeing a bounce here with the green line, but then it was flat on Monday. This is also positive longer term. Weekly chart of the S&P 500, we're still above this R1 level at 5110, 5111. Can we see enough strength to get back above this R2 level? And we're seeing a little bit of an improvement here with the fib extensions. We're above the 23.6, but below the 38.2% extension for the SPY. And we're seeing a mixed picture here, looking a little more positive with the Heiken Ashi, a little more positive with the Kegi, but the Renko continues to decline, and the three-line break is still declining. Long term, not really much of a change here with our 150 and 200 period moving average steady. We're still negative in the short term with all the different stock indexes, but we're also negative in the intermediate term with the NASDAQ 100. Saw a little bit of a tick up in commodities. They had been negative across the board. They're still negative intermediate and long term, where now the dollar is negative across the board. And we saw lots of blue and green here. So some positive things ended up happening. We got above 50, as I pointed out, with the BPI, with the S&P, and oil is going up now. Gold is also going up. So we have to look at the context for why is oil going up here. And we had tech, energy, and utilities were positive on the day. All of the other sectors ended up being down, with communication being down the most. And they made some changes here, but they still haven't changed the PMO signal here on the decision point scorecard. Based on the trend, we're negative in the short and intermediate term. And the equal weight, even though it's declining, it's still above the S&P 500, even though they're on different scales. This tends to show that the broader part of the S&P 500 is holding up better. And we continue to go up here with our ratio as the mega caps held up fairly well in Monday's session. We're still negative when we look at the raw score of the new highs minus the new lows on the NYSE. We're getting a minus 22 reading. And we're just a little bit below the 50-day moving average and this pivot point with the Dow. We continue to be neutral with the diamonds. We're hitting this upper head resistance here with S1 for the NASDAQ, and we really haven't been able to break above that and close above it. We're looking a little more positive here with the NASDAQ 100. We got above this S1 level, and we're able to close above that. And then looking at the Qs, we are neutral, and I don't know if something happened. I had a weird message flop up here. I don't know if that's going to mess up this video or not. We're turning back up with the NASDAQ 100, but we're still negative after being extreme with the PPO for the NASDAQ 100. Still in between here now, the moving averages, the 20s cross below the 50, but we're still above the 200. And trying to come back up, claw its way back after falling all the way down below these fib extensions for the QQQs. Small caps were down 1.25%, dropping below this S1 pivot point right now. And looking a little more negative here with the Russell 2000 small caps, still below the 50-day moving average, below 50 with the RSI. The momentum continues to be negative. And we are still neutral with the Elders Impulse system. And looking at the ratio between small caps and the tech sector, it's continuing to come back down after it really had been breaking out. And we're still negative here with the mid caps. We're below the 50-day moving average. We're below this S1 pivot point. We're neutral with the Elders Impulse system. We did bounce up off of the 200-day moving average with the FANG index, but it was virtually unchanged on Monday. After coming down, breaking below this support level with this trend line, we're above that, but we're still below this other shorter term trend line. The Wilshire is holding up okay. It's underneath its 50, but above its 200-day moving average. Also, we could say the same thing with the total U.S. stock ETF. And looking a little more negative here with the Amex, NASDAQ, and NYSE with the 5-period moving average of the highs minus the lows, we're dropping more negative, and that's more broad market. And we're coming back down here with our staples to tech ratio. If we're going to turn more positive, we want to see this ratio continue to decline. We're coming back down to the 50-day moving average with the financial sector, but it's been one of the stronger areas lately. And the dollar, it was up in after hours, but it ended up declining and virtually being unchanged by the time we closed with stocks. Getting back above the 50-day moving average with Apple, still below the 200-day moving average with Amazon, in between with Google, coming back slightly above its 200-day moving average with Microsoft, showing a little bit more of improvement above its 50-day moving average with Meta or Facebook. And NVIDIA is also between its 50 and 200-day moving average. Tesla still below its 200-day moving average. Netflix in between the 50 and 200 for right now. Still seeing a pretty strong correlated relationship on a short-term basis when we compare U.S. to international stocks. Longer term, it's also showing that the correlation is getting stronger. This is what we want to keep an eye on. We actually got back up into the low 80s now with oil. If something happens in the Middle East, this is likely to go up and gold is likely to go up. And we were down with the 10-year yield. We're also up with the 10-year based on price. We're not really seeing much, at least any strength with our growth to value ratios, although we're seeing a bit of an improvement with the Qs to S&P. Discretionary to S&P is just not looking very good. Large cap growth is still underperforming large cap value. It's below a declining moving average, although improving. So the large caps trying to show a little bit of improvement. Mid caps and small caps are just kind of dangling below their moving average. We came back up just a little bit with the S&P to utilities ratio. If we want to be more positive, we want to see this ratio going up. And we're switching back a little more positive here based on price. With the advanced decline ratio, we're above zero, but we're still below zero based on volume. Coming back down with the Staples to S&P ratio, we want this to continue to decline if we're going to be more positive with the S&P. So what's our outlook? Really not much to change here. We're negative, but showing signs of improvement for right now. And we're going to get PPI. That's the biggie that's coming out on Tuesday. And then all the geopolitical mess that anything could influence the market, or things could happen and the market doesn't even pay attention. And then we're going to get CPI on Wednesday, retail sales on Thursday, as well as industrial production and capacity utilization. And then I have consumer sentiment highlighted here, but housing starts and building permits, that is looked at as a leading indicator. Here's the other economic calendar if you want to see the forecast and what the previous readings were. Seasonally, we're neutral to positive with the Dow and NASDAQ. We're neutral to negative with the S&P, so not a real change. We are now coming into options expiration week, this whole week here, where we tend to be up a little bit more than down for the week. Tuesday is kind of a flip of the coin, whether it's positive or negative. And this is a new version of this chart here, where we'll be on the 9th trading day of the month. We do see a little bit of positive seasonality right now anyway. And then this has also been annotated a little bit. This is looking from 1968 versus, or at 1968, because that was a crazy year when the US just about self-destructed. And they had riots, and then Democratic National Convention was in Chicago. I mean, yeah, it's in Chicago again this year. And these are just different things that have happened, and then how the market has either reacted or not reacted. Again, the market doesn't really react to these things. It's more, what is Congress going to do or not do in the way of regulations? That is what really impacts the market. But this compares what happened in 1968. And after we had a very tumultuous summer in 68, we actually did pretty well. And until we sent Apollo 8 out to the moon, things weren't looking all that good in December either. And this is looking at 1987. And yes, you're going to get, okay, 1987 is shaping up just like it is right now. Anything can always happen. You know, I don't use these kinds of charts to make decisions, but they're just kind of interesting nonetheless. But now we're seeing a bit of a divergence here. As we were going up in 1987, we've been going down in 2024. And so that, for right now anyways, kind of putting this whole thesis into question. And then this is when we still tend to look pretty good, at least in the longer term, when the incumbent president isn't running for re-election. Also, August tends to be positive. It's September that can often be negative, both based on the previous chart and on this chart as well. This is kind of crunching things a little bit different, looking at this period from August to October, where it tends to be negative, the 3-month period here. But when we look at election years, this tends to be the best performing time for the month of August, is when we do have an election year. And then our warning signs, we're just keeping an eye on those defensive sectors, staples, utilities, and healthcare. And then what's going to happen with energy. Growth to value, discretionary to staples, they're showing some improvement, but they're not really leading right now. Our smart money indicators, accumulation distribution, the Chaikin money flow, and oscillator, they are negative, but they are improving. We have the S&P and NYSE McClellan oscillators and summation indexes, which are negative. The parabolic SCR, ease of movement, money flow, vortex are oscillators, but the slope oscillator is turning up and trying to cross back above its moving average. The ultimate oscillator is negative, the Copic curve, and the bullish percent index for the NYSE, as well as we're looking a little better with the NASDAQ 100 based on the PPO, which measures momentum, and the bullish percent index. It's still negative, but showing signs of improvement there. So our positive signs, the equity put call ratio is now back to going down. The advanced decline lines are holding up, except for the mid caps. We dropped below the moving average. The Swenlin trading oscillator is turning positive, and I have that in yellow. It's between a primary and secondary indicator. I just kind of have it right on the fence between the two. So instead of being the gold color, it's the yellow color. And this is the gold color, which is the bullish percent index is crossed back above 50. And that's a primary indicator. And the financial sector is still looking good. So not a real big change here from Friday. We're negative, but we're still, we're continuing to improve here. We're showing an improvement, but still negative in the short and intermediate term, where we continue to be positive in the long term. Thank you. I really hope you have a good day, and I will talk to you in the next video.